Warm welcome to all of you. This is A.K. Stari from Smart VRC, and on the pre-evening of the 15th of August, I wish you, all of you, from my whole team of Smart VRC, a happy Independence Day. So this is our webinar number 112. Thanks for your continuous support. So I have put all your audios in mute mode, and be very careful before enabling your video, because at times it happens that you are not aware and rest of the people are watching you. So be very careful. So today's webinar is, it's time to check your stocks. Yes, why this question has arisen? Because from last about a week or 10 days, several of the small and mid-cap stocks, which are the favorite of retail investors, are lagging behind. Not only lagging behind, but they are moving in opposite direction to the broad indices like the Sensex. So Sensex is rising, but our total portfolio of most of the retail investors is falling down. So investors are worried, and me too get many calls that our portfolios are falling. At times it becomes very difficult to analyze each and everyone's portfolio. So I thought of putting this webinar, how to check whether your portfolio of stocks is perfect, whether I should say near perfect or not. It happened even yesterday only that I received a portfolio of about 7 stocks, and it was upward of 50 lakhs, highly concentrated portfolio, but not diversified even with that concentration. So I thought investors must know what to be done and what not to be done. So there are both the points, what we have to do and what we need not have to do. So let's see how it pans out. So in this webinar, we are going to see the movement of small, mid, and large cap stock indices. Then Dr. Smart. Then what is the checklist? How we can check our portfolios? And then the question and answers. Well, these are the indices, rather indices of S&P, Bombay Stock Exchange for large cap, mid cap, and small cap. So the blue one, which you are able to see almost after half of the journey, this is the blue one is the small cap, and this yellow one, as you are able to see, yellow one is mid cap, and this green one is the BSE Sensex. So, and this for a period of 35 years. 35 years is pretty a good long time to reach to any conclusion. So what we see here is actually this mid cap and small cap, they were introduced in the midway. So that is why they are not appearing for the initial 15 to 17 years. And even from this midway, if you can see, the gap between the broad-based BSE Sensex and mid-cap and small cap is increasing almost every 2 years or every year. There is a consistent increase in gap between these two indices, gap in terms of the returns. And as you can see, the returns of BSE Sensex is 9,700, and we may have to reduce this 1 point but nevertheless, it must be around 5,000. And then BSC mid cap, it is 2,300 and small cap 2,800. So what is the conclusion? Conclusion is over a long period of time, large cap stocks, because the BSC Sensex is mostly large cap stocks combination. So over a period of time, large cap stocks far outperform the mid and small cap indices. Why? Why it is like this? Because most of the retail investors, and even in most of the investors, rather I should say, they are under the impression that mid cap and small cap stocks provide excellent opportunities to create wealth. But what we see from the chart is that the mid cap and small cap indices have far underperformed the BSE Sensex. Why it is like this? There is a controversy, right? There are contrasting statements. The reason is a stock once upon a time was a small cap, then it becomes a mid cap, then it becomes a large cap. So over a period of time, the good companies, they turn from small cap, they move from small cap indices to mid cap indices, and then from mid cap to large cap. So that is the reason. Most of the blue chips are in Sensex, in Nifty, and that is why their performance is far superior over a period of time. But if you go by the stock wise, then definitely it is the small cap and mid cap space wherein we have to search. We have to find out the future multibaggers, and then we have to stick to it. And over a period of time, you will observe that how they move from small cap and mid cap indices to large caps. And that is the core area of our expertise at Smart VRC. Well, moving to the 5 years, what is the status for 5 years? As you can see in the 2018, from 2017 to 2018, this blue color, that is the BSC small cap, was the best performer. And then the second in line was the mid cap, and the third was the BSC Sensex. So during this period, 2017 to 18, large caps were beaten down compared to the small cap and mid cap in terms of the returns, not in absolute terms. In absolute terms, yes, even large caps have also gained handsomely, but it was the winner was the small cap index and the runners was the mid cap index. But what happened thereafter? Thereafter, after 2018, rather I should say from the first quarter of 2018, the game changed, and again the BSE Sensex started outperforming compared to the mid cap and small cap. As you can see, this green line, this has far outperformed till last year up to March, right? And then afterward, what happened? As you can see, from the start of 2021, once again, this blue color, that is the BSE small cap that took the lead. Let's see in the next slide what happened during last 6 months. So this is the chart for last 6 months, and as you can see, the performance of small cap, the favorite of retail investors, it has given 34% returns till yesterday. Till yesterday, there was 34% returns, mid cap about 14% returns, and Sensex about 6.3% returns. So in terms of the outperformance, small cap has given 5 times more returns than Sensex, and mid cap has given more than double the returns of Sensex. So this is the case, and we also know how our portfolio has outperformed the Sensex during this time, and we all are happy, and why not? But the truth prevails. So this is for only 5 days, for last 5 days. During last 5 days, what has happened is Sensex is up by about 1.57%, Small cap is down by 1.68% and mid cap is down by 1%. And that is very clearly reflected in our portfolios, right? So how to check whether we are holding the right stocks or not? First is the absolute share price. Yes, this is a very, very good indicator. In most of the cases, you will find that if the stock price is less than rupees 10, then there is almost, I can say, a guarantee that the fundamentals are poor and even the future prospects are not good. Almost guaranteed. If the share price is less than rupees 10, whatever is the face value, yes, it is all speculation. Economy is not booming to that extent that even the loss-making companies can turn around and not only turn around, but steep turnaround. Then only the share prices of less than rupees 10 can move upward. But all the share prices which are below rupees 10 are almost, I can say, 99% of the chances, more than 99% of the chances are that those all are speculative. Stocks from rupees 10 to rupees 50, again, almost 90% chance. Yes, they are less risky than share price of stocks under rupees 10, but nevertheless, they are also risky. There are 90% chance. From 50 to 100, of course, on selective basis, there are some good stocks, but still very less. You would be surprised to know that in my watch list of about 180 stocks, there are only 3 stocks with a share price below rupees 100. Yes, only 3 stocks. So what is the difference? Most of the retail investors, they are looking for investing into stocks whose share price is low. I still remember a day when I recommended Bajaj Finance before split and before bonus. Yes, that means the 10 times of present price. Share price was about 4,400 rupees. I asked him to buy this share from long-term perspective, and he said, Mr. Asnani, I buy not less than 100 shares, and I don't have the money to invest for a stock worth rupees 4,400. So I said, if I give you a stock worth rupees 44, will you invest? He said, yes, I will invest in that. So try to understand, it is the same thing. The only difference is the number of shares. And it is not the number of shares which decides your returns. It is the quality, it is the worth of the stock, it is the story, it is the future prospects of the stock which decides your returns. And there is a general perception in, I can say, more than 95% of the retail investors, they are not willing to invest in high-priced shares. They think that those high-priced shares are more riskier. And since more than 95% of the investors think like this, they become less riskier and the low-priced stocks become more risky. Yes, and that is the reason why most of the stocks which I recommend are about rupees 100. Not because I have affection for high price shares, but it is an automatic. So one is the absolute share price. If it is below rupees 10, there is a very high probability that it is time to exit, rather I should say, in a very straightforward way. Past financial performance. Yes, one must look for the past performance. That is the basis, that is the fundamentals of the company. That forms the fundamentals of the company. Try to see what is the past performance. And let me tell you, the current, I have been in stock market from last 31, 32 years. And this is the first time it has become so difficult to compare the performance, to compare the financial performance of the first quarter. How should I compare? If I compare with the last year's same period performance, so it is not correct, because during the last last year quarter, there was almost for 1.5 months, 2 months, there was a complete lockdown throughout the country. Even for the current quarter, that is the first quarter, there was a lockdown in many of the cities. So how to compare? Even if I want to compare on sequential basis, that is for the quarter ended 31st March 2021, that is also not correct, because for the first quarter, there was a lockdown. So it is really very difficult. Not only that, raw material prices are very high, steeply high for the first quarter. Again, like on like basis, comparison is not possible. So it is very, very difficult. So it is very much imperative that you must look for the financial last, at least yearly performance. How is the company performing? Whether it is making profits or not. That is the most essential thing. Many of the companies are not making profit and their share prices have increased by 5 times, even 10 times. So we must be very careful. This is the right time to dispose of the junk stocks from your portfolio. Yes, I know. Being an advisor, not many people contact me for analyzing their portfolio. And also we have a service with the name of Dr. Smart. I will come back to that service later. And under which I find that how many stocks investors are holding and how many junk stocks they are holding. Recently, I happened to see a portfolio which has 213 stocks. I wonder whether we can even monitor the performance of the share prices, leave apart the fundamentals. It is very difficult. So look for the financial performance. Book value gives you an idea about the accumulated profits. Of course, not an exact idea, but a rough idea. And many of you may be aware that recently, very recently, there was an IPO which had a huge negative reserves and issue got subscribed. So that is retail investors. That is the power of retail investors. They just want to apply for the IPO and they consider IPO to be very safe. And let me tell you, as per my opinion, IPOs are the most riskiest. Yes, most riskiest. Okay, there is another thing. Then coming to the dividend, yes, I look for the dividend I give very high weightage to the dividend, because if the company is not making real profits, then that company cannot give dividends. So check whether your company is a dividend paying or not. There are very, very rare cases wherein the companies are performing very good, but they are not declaring dividend, like 3M, but then their share price is very, very high. 3M is about, I think, 24,000 rupees. Or rather, yeah. So dividend is must. So this was about the 4 points in the checklist. We have one scheme with the name of Dr. Smart, and we do the very exactly the topic which we have today. We analyze the stocks and let us see what else we do under this scheme. So this is the scheme, Dr. Smart. First, we assess the investor's risk return profile, because an investor who is risk averse, that means who does not like risk, then definitely he must be having more of the large caps, more of the big companies, more of the proven companies. So one must assess what is the risk profile of the investor. Then only we can advise how to reorganize the portfolio. So after assessing the risk profile, what we do is we analyze the individual stocks in terms of the past performance as well as the future prospects, including everything, including this future story, the management, and all those things. And accordingly, we give the buy, sell, or hold advice, and with a very brief note of about 2 to 3 lines that why we are advising to buy or hold or sell. We also advise, if it is required, to what stocks you can add. And then in the end, we optimize the portfolio as per the risk return profile of the investor. That is how much weightage each stock should have, and accordingly we advise you to buy or sell so much number of shares. This is all about the Dr. Smart, and in the end we also comment how we have changed the risk and return equation of your portfolio. So those who are interested more about this, they can visit our website smartvrc.com, and under the products they will find Dr. Smart, and there is a lot of detailed literature available there. So this was in short about Dr. Smart. So coming back to the checklist. So we have covered about the absolute share price. Lower the share price, more is the risk in general. And then the past financial performance, there is a must. What about the book value? That tells you about the accumulated reserves, accumulated profits or loss position. And then the dividend, that ensures you, if a company is dividend paying, that ensures you that the cash flows are positive and real. Yes, manipulation is very much possible. You can show a lot of profits, but without actually earning profits, but you cannot pay dividend without actually earning profits. So that is why dividend is very, very important. And then the retail investors stake. This is also a very good indicator. That whichever company whose share price has fallen steeply during last couple of years, you will find that the retail investors' stake keeps on increasing steadily. Be it a Vodafone, be it a PC Jeweler, be it a Reliance Capital, be it a Yes Bank. You look back and you will find that the retail investors are more confident. They have more confidence in the low priced shares, rather I should say in the shares which are falling, compared to the fund managers of the mutual fund or the FIs. Do we really have? So that is why be very careful, and you look for the retail investor stake. That also will give you a good idea what is happening, whether the smart investors are getting out and you are being trapped. Then comes the story. Story is the future. What is happening into the future? I will tell you, there is a story of Acrysil that makes a very special type of kitchen sinks. And that company, year after year, was increasing the capacity gradually. It was steady increase at the rate of about 10 to 15% every year. I am talking about the capacity expansion. And then came the COVID. And during the COVID time, when the people were sitting at home, especially in developed countries, I'm talking about the US and Europe, there people started renovating their kitchen. And also, coincidentally, at the same time, company got tie up with IKEA for selling their kitchen sinks. Suddenly, demand spurted. So much so that they have increased their capacity by about more than 50% during last 1 year. They will be increasing within a year. They will be able to increase their capacity by 50%. It is already underway in phases. Not only that, they are already creating infrastructure for doubling the capacity, more than doubling the capacity from the current position. So there are companies which have really done fundamentally very, very well. Not only well, but they are going to do well. Already share price is up. In September, we recommended at rupees 129, and today it is more than 600 rupees. So I'm not recommending this stock. I'm just telling you, check for the story. Just because the share price is up by 4 times or 5 times does not mean that it is overpriced. If, as I said, if it is high priced, then look for the story, look for the fundamentals. It is not essential in high price shares, especially. In low price shares, if a stock was rupees 1 and today it is rupees 5, then definitely I'm very sure there is no story. It is just a speculation. But if a share price has moved up from, say, 500 rupees to 4,000 rupees, then definitely there is some story. Like in Tata Elxsi, there are many examples I can quote, which have fundamentally there is a structural change in their business model. So Once again, whatever the stock names I'm quoting, these are not the advice to buy or advice to sell, just an example. Then weightage in the portfolio. This I have discussed a couple of times. Weightage in the portfolio decides how your portfolio returns will be. With the same set of stocks, I can design n number of portfolios depending on how I have given the weightage. Suppose if you have an ITC in your portfolio with 100% weightage, then the returns are zero from last 6 months. And if I have 50% ITC and 50% Sensex, then the returns are maybe about 6%. If I have 50% ITC and 50% small cap index, then my returns are about 15%. So returns vary depending on how I change the weightage of ITC. That is how the weightage functions. It has a very high say in deciding your total returns. But often people neglect this parameter. Weightage means the allocation in your portfolio. With every advice we give, how much should be the allocation of this stock in your portfolio? So depending on all these 6-7 checklists, you can reorganize your portfolio. Nothing to be worried, but try to understand that this is a part of the stock market. Sometimes small cap and mid cap will outperform the stock, broader stock indices. Sometimes they will underperform. It is we as an investor, we have to be always rational. We have to think what is actually good, not what the market is saying. It cannot happen that small cap and mid cap can continue to outperform the large caps forever. It cannot. Someday will come when there will be a turnaround, right? I'm not saying that there is a turnaround part because I never tried to predict any kind of stock price movement in the short term. So apart from that, I can help you more. As during my last webinar, I shared what are the sectors wherein how we see the valuations at the current prices. This is the list. This can help you. In addition to the checklist, this can also help you. And there is more to this. There is one slide. There is one more slide. This one. So these are the 2022 sectors wherein this can be of help to you. So my idea, what I was telling is, it is not the market cap which decides the long-term returns. It is the performance, it is the fundamental, it is the story of the company which decides. And if the company is good, if the story is good, then definitely market will have to acknowledge the performance sooner or later. So this is a very good example. These are the month-wise best, I should say the best stocks month-wise, what we have recommended in our product Smart Gains. And you can see that there are Polyplex is a kind of a mid-cap company with, and Uflex also with a Uflex, and these are on the borderline of small cap and mid cap. These are high-priced stocks. There's about, I think, about 1,200, 1,300. Uflex, about 500 rupees. Mindtree is a mid cap. Shivalik Bimetal Control, there is a small cap, very small cap, maybe around, I think, 1,500 crores, or not even 1,500 crores, below 1,500 crores market cap. But still, the returns, see the returns from 83 to 172. Sunflag Iron is a small cap. Equisil, very small cap, I think about 1,000 crore market cap. Tata Steel is a large cap, and then I cannot disclose the name because this was recommended on 11th of August, just 3-4 days back. We recommended at 202, it is 225, and the market cap is still very small cap. So as you can see, it is a mix of small, mid, and large caps. It is not, we are not targeting any type of market cap to advise the stocks, but we are targeting only the performance, the past performance, and the future prospects. That is the way to go. And that is also truly reflected in our performance of SBP, that is a part of Smart Gains. And this is really a very, very vertical type of thing, which I have never experienced during last 21 years when we started this, 20 years, sorry, when we started this SBP with 1 lakh, and today it is 1.24 lakhs. And there is no letdown during last 1 week also. So this for up to 10th of August, but even today it is, yesterday it was 124.6 lakhs. So 1.26 crores. There is no letdown because our portfolio is very rightly balanced. I will show you how. And during the same time, during these last more than 20 years, if one had invested in BSE Sensex, the returns would have been 15.13 lakhs, and we are at 124.3 lakhs. Our CAGR is 26.5, and BSE Sensex CAGR is 14.38%. So this was about SBP, and this is how our SBP portfolio structure is in terms of the large cap with 63.63% weightage. Large cap means more than 25,000 crores. Small cap less than 10,000 crores, and mid cap 10,000 to 25,000 crores. Just 26%, this 10%, and this 63.63%. So this is how we are. As the market progresses on the upside, we come near and near to the top, and that is why as we move upside, I keep on increasing the proportion of the safe stocks. Safe stocks means which should not get affected. I mean to say, when I say which should not, means whose performance should not get affected with any change in economic direction. So that is why we have a pretty high proportion of 63% in large caps, 26% in mid caps, and 10% in small caps. As far as the weightage is concerned, as you can see, we are very evenly weightage with a high proportion to IT because there is less risk in IT. Reason is it is an export, it is exporting. Most of the IT companies, all of the IT companies which we have in our portfolio are in the export segment, and rest of the sector weightage is pretty below 15%. So this is how we are evenly balanced in terms of, not only in terms of weightage, but also in terms of the large cap, mid cap, small cap, also in terms of the business groups. So nothing to be feared. And if you are fearful in the market, then you cannot go far. There is for sure, I can say, with fear, you cannot go far. And also with full of greed, also you cannot go far. So you have to be very, very rational. Yes, in my last webinar, I declared that we are coming out with 5 emerging stars, come potential multi-baggers. Meanwhile, we have spotted one very good stock. So this report we have postponed. We shall definitely publish this report, but later on, or maybe in a different format. For the time being, soon we are going to launch a smart report, a stock, single stock, supported with a research report, as usual, always. And share price is between 400 to 600. I cannot give you the exact share price, otherwise people are very smart. They can go to the scanner websites and they can find out what is the stock, name of the stock. It is a large cap and very strong fundamentals and very strong story, and is serving different geographies. So it is not dependent on a single economy. And we are targeting returns of 2.5x in a period of 4 years, and perceived risk is medium. Actually, it is, I can say it is a low risk, but to be on the conservative side, put it as a medium risk. And subscription price, as usual, it is 1,000 rupees and GST of 180 extra. Soon you will be informed in our WhatsApp group and other social media. Yes, I request all of you, if you have the friends, or in case you are attending this webinar for the first time and you are interested in creating wealth in the medium to long term, then I request you to please WhatsApp your name and city on this number. This is our WhatsApp number, also appearing on my left side. This is 9755920780. So with this, we come to the end of today's webinar, today's presentation. Sorry, not webinar, today's presentation. And now this will be followed by question and answer session. Thanks. Thank you. Thank you very much. So you can ask your queries on the chat box, or also you can raise your hand in the by pressing the reaction button appearing on your screen. Mr. Ravi Kisan, kindly unmute yourself. Yeah.
Yeah. Hello. Good evening, sir.
Thank you. Yeah, good evening. Your voice is a bit low.
Now, can you hear me, sir?
Yes, yes, sir.
Okay, sir. Sir, thank you very much for a nice presentation again, sir.
Thank you.
Sir, my one question is, how is investing different from financials? Because if you these days, when you read, you find so many things. So some is many people are just too much into financial side. They will open the Excel sheet, do this, do that, so many things. But it is not like every person can do. But investing is for everybody. So
Yeah.
how is investing like a normal guy who can add and subtract and understand the trends and all? That is one part. But he's not so good in with the Excel sheet and reading and making so many things. So
Yeah.
how's that different from investing? Can I be an investor, good investor with a good prospect, even if I am not so good in finance?
Yes, sir. Very interesting question, and I think you are the first one to ask this. During last 1.5 years, we have conducted about more than 110 webinars, but no one ever asked like this. And to give you an answer, first and foremost is myself. Basically, I'm an electronics engineer. And then after joining BHL, I got interested. And over a period of time, I added the qualifications. And presently, I'm pursuing PhD. And to be very honest, this much of education is not required. It is very simple. If you are able to understand the finances of your own house, on your own income, on own debt, then you are very well equipped to analyze the company's financials. It works on a very, very same principles, same things. When you go to the bank and ask for a loan, what they look for is something about 40% of your income should be free for your monthly expenditure. And the same holds good. The ratios may be different, but the same holds good for the companies also. They need some working capital. So we need to understand their cash flows. But not much is required to understand the cash flows, because it is very difficult part. And that is why repeatedly I say that look for the dividend. If the company is distributing dividends regularly, that means its cash flow is okay. Because like in infrastructure, if the company is growing in an infrastructure sector, then cash flows will be most of the times it will be negative. But that does not mean that the company is not doing well, because the nature of the business is like that. Once you complete the project, then only you get the major chunk of the money. But in case of like insurance, beforehand you get the money and then you provide the service. So definitely in insurance companies, cash flows will be positive. So it is very difficult for a retail investor to really understand the cash flow. And more than that, you will find that most of the companies which have become blue chip during last 5 years or 10 years, most of those company products, you are knowing that they are doing very well in the market. Their services, you are well aware that their services are very good. So we just missed it. Like, I will give you an example. For Bajaj Finance, for how many decades I am saying, we all knew that there is a tag of Bajaj Finserv wherever we go, wherever whenever we go for buying a television or refrigerator, there was a tag of Bajaj Finserv. Why not we purchase the share? So there are many examples you also can quote, like for Maruti, that was the first revolutionary product, revolutionary car, I should say. Those were the days when I myself used to drive the this Padmini car and also that Ambassador. And then when the Maruti 800 came, I knew what was my reaction. I cannot forget that day. How there was a change of technology, change of shift, how we drive the car. So we all got the opportunity to buy Maruti shares. And same is the case with Page Industries. There are lot many examples. All these companies have gone were very small companies, were very their share prices were very low, and we all got the opportunity. So this is one way. And then secondly, as I said, just look for the last 3-4 years performance, how those companies are doing, and you will get an idea. So it is not essential that you should be very expert in finance. And moreover, if it is a pure science, then I believe all finance experts should have been croropatis, but that is not the case. And because apart from picking a good stock, what one requires is also the control on emotions. I know many people who are not at all expert in picking the good stocks, but they have very high control on their emotions. So whenever the market falls by more than 30%, I know one gentleman, whenever he is 15 years elder to me, that means he is around 70 years as on date. He said, whenever the market means the Sensex falls by more than 30%, I buy all the blue chips. All the blue chips means all the A-grade stocks. And he has never sold anything. And he is earning 19% CAGR from last so many years. So for him, picking a good stock does not matter. He picks only the proven blue chips and he plays on emotions. So that is also one of the ways. So there are different ways. What matters is you should be able to generate more than the Sensex returns. Otherwise, invest in index fund. Even 15% returns are too high compared to the other returns we get from the alternate assets. I hope I answered. And if I am not wrong, you are from Kuwait, right?
Yes, sir.
You are from which country, sir?
Oh, right now I am in Switzerland, sir.
You are in Switzerland. Okay. Earlier you were in some other country, I believe.
Yeah, from there I shifted. Yeah.
Oh, okay. So I hope I replied to your query.
Yeah, sir. Always, you were always so informative, sir. Sir, can I just add one more question? Sir,
Yes,
how do you think about the changing fundamental shift that is happening right now to the electrical vehicles and the solar, like all those renewable, push that is happening, that is Borosills and all those panels, and I'm talking about even Praj Industries or something like that, who are like more futuristic point of view, including the battery and cells and even the hydrogen push now I'm having. So,
yeah.
sir, how do you see this new future being unfolding? So
Okay.
how do you want to play and how do you think it? Or still it is too early to think, or you want to wait? Thank you very much, sir.
Yeah, very intelligent question. And many people ask about the specific sectors, but you are asking as a total. So my everybody has his own way of working, own way of picking the stocks. My way is first show me the performance. I don't buy any stock just on assumption of any story. I buy first show me the results for at least 2 quarters. Show me what you are doing. Show me what orders you have, like this. So with that respect, so sector wise, first coming to the EVs, it will take time. Definitely, it will take long time. And but in developed countries, EVs may be a reality sooner than in our country. Nevertheless, the opportunity will be very big, but it will take time. But there are very specific type of companies which are producing the components for them. We can search for them. We can start with a small weightage, small allocation in our portfolio, maybe say 2%. You can start with 2%. So there is not much risk. And over a period of time, as the story develops, you can increase your weightage, or maybe it is possible that you may have to exit also. It depends how the story of EVs goes. But one should not have a high weightage of stocks on mere expectations. Okay. Lot many things cannot be done in India. We need technology. So even for batteries also, we need technology. And technology transfer is not going to be that easy. So be very cautious and don't over allocate the stocks, the companies based on your EV expectations. Coming to the sugar, as I repeatedly say, for the sugar, the input as well as the output is highly controlled by the government. So it is very difficult to predict. Moreover, the ethanol target is for 2023, still 2 years or 2 or 3 years or more. And in the meantime, if the crude comes down to say $50 per barrel or even lower than 50, then I'm very sure that ethanol story will again take a backseat. So I'm not, at the present juncture, I don't think we should go for in a big way in sugar companies. Even we can wait, because in the coming 2-3 years, there will be a downfall, there will be a correction, can be a big correction also. So that would be a good time. Coming to this solar power, specifically you refer to Borosil. For that company, it is very much dependent on the government how it applies the duties or anti-dumping duties, rather I should say, to the other countries. It is not much dependent on that, because on a standalone basis we are not competitive. And also there are a couple of companies which are very serious in solar power. Yes, one can have a decent allocation of 4 to 5% or even 6% in such companies. So I think for most of the sectors I have covered. But once again, I say, I always buy first, show me the performance, then only I buy. So that is how I pick the sectors. I never pick the sector-wise stocks, but I always look for the company, then the sector, and then the economy. But first, show me the performance. So I hope I answered you to your expectations. Yes, Mr. Ramesh Allen, kindly unmute yourself. Mr. Ramesh Allen.
Good evening, sir.
Good evening, sir.
Achha, regarding these polyfilms companies,
Yeah.
they have run away like sky.
Yeah.
Huh?
Yeah.
Like the Polycap or Cosmo Film. So there was a huge demand for these companies.
Yeah.
Now the government is thinking of even scrapping the single-use plastics and other polyfilms.
Mm-hmm.
So how they will perform in future, these companies?
Okay.
They got.
Yeah. Even after so much of rise in share price, can you share the P ratio of Polyplex or Cosmo Films or Uflex?
They may be very high. I have not seen that, but
okay. Let me tell you, they are still, their P ratio is very low, and to my knowledge, Uflex is quoting at a P ratio of 6 or 7, and Polyflex and Cosmos something about 10 or 12. So P ratios are still low. And over a period of time, if you look for the growth rate in earnings, it is net profit is higher than the P ratio. And also these companies are not producing that single-use films. They are into food packaging and quality food packaging, and also they are exporting. So definitely a company which has export of more than 50% to US or Europe, definitely that company is using a good quality kind of material. Also, because of the low crude oil prices, these companies enjoyed the low raw material prices, till December, and the rise in the prices of raw materials will affect their profit margins in the coming quarters. But at the same time, due to this COVID, now more and more from the safety point of view, more and more people are preferring a good quality packaging for the food products. So again, there is a increase in demand. So overall, I don't think all these companies are overpriced. These are just evenly priced. Most of the companies are evenly priced. Even one or two companies are still underpriced.
So still there is a room for their growth.
Not in the whole as a sector, but in a one or two companies, there is still a scope.
Another I want to ask you, this Zomato company, Zomato, the IPO came. Zomato.
Yes, sir.
Hello. The IPO came and the premium went to more than double. The company is making losses.
Sir, that we cannot comment. There are all type of investors, all type of companies in the market. You have to remain very rational. That is the thing only I can say.
Despite they are making huge losses, still the share price is going up. So that's why I'm a little surprised.
That is not in my hand.
Or they are looking out the future, this one, futuristic.
Maybe, sir, I can't comment. Means on very stock specific, we don't comment. And yeah.
Okay, thank you. Thank you, sir.
Mr. Jigar Bhasa.
Hello. Hello, sir.
Yes, sir.
Yes, sir. I subscribed for Dr. Smart last week. So you suggest me some stock to switch, but I already have that stock from your other product like Smart Gain, and so how could I manage the weightage as per your?
Sir, you have this is a very personal type of thing, and I think it would be better if you write me on the WhatsApp or email. I will reply.
Yeah,
you.
sure.
Okay.
Okay, no problem. Okay, sir, no problem.
If you have any other query, then let me know.
No.
Okay. Thank you.
Thank you, sir.
Mr. Dinesh Tiwari.
Good evening, sir.
Yeah, good evening, sir. Welcome.
Sir, I have three interlinked queries, but I will ask one by one. First is, how much money should we keep idle in saving account so that we can, anytime we get an opportunity to buy a good stock at a low price. So how much, for example, if a percentage of our salary to keep idle. This is first. Then second is, if there is one point, if we have to keep, if we want to be invested fully, then we don't have any money to purchase a new stock at low price when the opportunity arrives. And third is, should we book good profits by selling good value stocks like Infosys or Happiest Mind of kind of stocks to keep ourselves future ready in case if bubble strikes and a bubble burst in near future, because nobody can predict when that opportunity will come, the kind of opportunity that we got in March 2020.
Yeah. Okay. Yes, as you said, all these three are interrelated questions, and as a principle, I never keep cash. I myself also don't keep, and I don't advise to keep cash, because if you are keeping cash, that means we are trying to predict the market. And it may happen that for years together, market may not come down, may not fall, and we may lose the opportunity. So the best way is to remain always invested. And as I showed, as the market moves up, we also know that the market is getting heated up. We all know. So why not to shift more towards safer stocks rather than keeping a cash? Why not we sell our speculative stocks? Why not we sell our overvalued stocks and shift to a more safer stocks? When the market falls, as you said, that then at that time we may not have any money to invest, but then always we can sell the stocks which are more safe, because when the market falls, as the market falls more and more, it becomes less riskier. Yes. Kindly monitor the words I'm saying. As the market falls more and more, it becomes less riskier. So as the market falls, you should, I should not say you should, but what I do is I move from the safer stocks to a little bit more riskier stocks. Yes, because it cannot fall permanently. Corporate cannot burst. It can never happen. And if at all the corporate goes burst, then the government will, whole economy will collapse. And if the economy collapse, then why only about the stocks? Everything will collapse. Land prices will also collapse. So we are at a very safe point. No government will ever try to let the corporate collapse, because all the government revenues are from corporate. So have confidence on the corporate. That is very much required if you are investing in stocks. So as what I said is, as the market, we did the same thing during April, May, and June. What we did is we shifted from more and more safer stocks to a little bit more riskier stocks. We acquired stocks with a debt equity ratio of 1:1 also. Because if a company is able to survive even during the toughest of the economy times, then that company is fit for investment. Whenever the market bounces back, whenever the economy bounces back, that company will be the major beneficiary due to the leverage. So that is the way to operate. And we have applied this technique, and we have generated more than 26% CAGR from last more than 20 years. And it works every time.
Thank you, sir. Thank you very much.
Yeah, Kumud Giri, kindly unmute yourself. Kumud?
Unmuted.
Yeah.
Yeah, some question. Steel, why steel price goes, steel sector goes high and high and high.
Mm-hmm.
What is the reason? It will continue or
Okay.
something? मतलब एक कोई बड़ा blunder होने वाला.
Okay. So it is like this. कोविड के खत्म होने के बाद चाइना में बहुत सारा इन्वेस्टमेंट किया जा रहा है, उनकी इंफ्रास्ट्रक्चर में काफी इन्वेस्टमेंट किया जा रहा है. एंड ऑल्सो चाइना में अपनी पोल्यूशन को कंट्रोल में लाने के लिए काफी सारे जो कंपनीज स्टील फर्नेस रूट से बनाती हैं, उनको बंद करने को कहा जा रहा है, या फिर उनको प्रॉपर इक्विपमेंट्स यूज करने को कहा जा रहा है ताकि वो पोल्यूशन कम से कम हो. तो इसलिए वहां पे स्टील प्रोडक्शन कम होते जा रहा है. अभी आपने सुना होगा कि यूएस में $1 ट्रिलियन यूएस इकोनॉमी में इंफ्रास्ट्रक्चर में डाला जा रहा है. तो अगेन उससे भी स्टील की डिमांड बढ़ेगी. और इंडिया में भी हम जैसे ही सेकंड वेव से बाहर आए हैं, तो हमारे यहाँ भी इंफ्रास्ट्रक्चर में गवर्नमेंट काफी खर्चा कर रही है, इसीलिए स्टील की डिमांड बढ़ती जा रही है.
तो देन अभी टाटा स्टील में हम फिर से इन्वेस्टमेंट कर सकते हैं कि नहीं कर सकते?
आप मेरे ख्याल से आप हमारे सब्सक्राइबर हैं, एंड यू विल गेट द राइट एडवाइस एट द राइट टाइम.
Yes. I have got some option trading. We take the risk for the trialing. What is our option trading? Or so Tata Steel I have taken 1160, 1140, 1160, 1220, 1260, and yesterday I have taken on 1460 call option. So,
Okay.
but it is very risky. I know very well.
We don't advise for derivatives, so I cannot comment on that. There is
मैं बहुत पुराना सब्सक्राइबर हूँ और बहुत पुराना जानता हूँ.
yes.
तो मेरे को ऐसा लगा कि मैं कुछ ऑप्शन ट्रेडिंग करके देखूं एक बार. तो मैंने टाटा स्टील पे आजमाया. तो मैंने ये सोचा कि इसको आज मैंने विद इन जुलाई सीरीज और अगस्त सीरीज में देख रहा हूँ. तो 1160 से 1140, 1160, 1180, 1220, 1240, मतलब इसका तो ऐसा भाग रहा है कि मेरे को ऐसा लगा कि कुछ एक्सीडेंट होने वाला है बड़ा, इसलिए मैंने ये क्वेश्चन करा.
वो आपका पर्सपेक्टिव है. हम अपनी तरफ से फंडामेंटल सेफ तरीके से आपको एडवाइस देते रहेंगे. थैंक यू. ओके, मिस्टर आशीष दीवान.
Yes, sir. Good evening.
Good evening, sir.
Yeah, hi. Sir, एक query था मेरा, during the March quarter, the cement companies made a lot of profit because of the pet coal prices went down, and there was they said in the annual reports that this may not continue. In first quarter FY22, this will not continue, but again the numbers are coming better now, or equally good.
Mhm.
So what do you say to that? How long this will continue? And internationally, the oil prices are again going down.
See, in the very short period, we cannot comment, because in a month or two, we cannot comment. Look for the longer horizon. Indian government has to provide employment to the lower class, to the laborers, and so Indian government has already made a substantial provision for infrastructure development. And also, you must have heard that there is a strong demand for affordable housing even from Mumbai, and so the demand for cement is strong. We cannot forecast how the coal prices will move or how the cement prices will move, but definitely over a medium term, we see a good demand scenario for cement stocks, and couple of stocks are available at good valuations, attractive valuations, rather I should say.
Sir, I was talking about the raw material price for cement industry.
So raw material price is in a sense that mainly is coal and energy, and so कोई भी जैसे company चला, whoever is running a company, if the raw material prices are going up, then definitely he will try to pass on to the customers. But there is a lag of a quarter or two. So we need not have to bother too much about the raw material prices. This is applicable to almost all the sectors. Even for steel companies, raw material prices are rising, but it's still the output, the final steel prices are moving up. So what matters is the difference. And if there is a good management, that will take care. Even for automobiles, companies are raising the prices of their vehicles. So because of the increase in raw material prices.
Yeah. So you see the next quarter also coming like this? Coming quarter?
Yeah, on quarter-to-quarter basis, there is not going to be a much difference. If the last quarter there was a COVID, and now in the current quarter it is almost very normal. So why should there be a decline in demand for cement?
I'm saying the raw material prices. Okay, fine. Because raw material prices went down in January to March, they made huge profits, and again now in June they are making huge profits. But in annual report, they themselves said that this may not continue because raw material prices are increasing. But
So
the results,
very
yeah.
specific for a company.
Sir, for example, I heard for Sagar Cement.
Tata?
Sagar Cements. Sagar Cement.
Mm-hmm.
So
Sagar is a very strong player compared. You look for the statements given by Ultratech or Shree Cement or these companies. Sagar Cement is not even 1% capacity of the total India's cement capacity. So for a regional players, for small players, it can have an impact because they are serving the regional areas.
But okay, fine. ठीक है sir. Yeah.
So there are a lot many, I can see in the chat box, there are a lot many very stock specific queries. Sorry, I'm not going to reply to such queries. Okay. Is there any minimum amount we have to invest in your advisory stocks? There is no such minimum amount, and this minimum amount may vary from investor to investor. So that is why we provide you allocation, how much you should allocate with respect to your total portfolio. So if I say allocation is 4% and your portfolio size is 5 lakhs, that means you have to invest 20,000 rupees. And if the portfolio size is 50 lakhs, so you have to invest 2 lakh rupees. So it varies from person to person, but the allocation remains the same. This is regarding the okay. This is regarding our products, Smart Report and Smart Multibagger. Smart Report is not a regular product. It is an occasional type of thing. From time to time, we publish one stock, and most of the times it is a part of Smart Multibagger only. But at times, Smart Report is independent, not a part of any of the products. And a lot of appreciation I can see. Sorry, I cannot read all those comments, but I'm very much thankful to all of you. How do you see now as government launched scrappage policy 2 days back and current running EV story both will run parallelly as sector will have boom and tailwind from now on? So it is not exactly like that. Ultimately, it depends on the buying power of the customer. If he is not prepared, then let EVs come, let scrapping policy come. If he don't have the purchasing power, he is not going to buy, or he may even buy a lower priced vehicle if at all is forced. Like in scrapping policy, yeah, it will be a boost, but to a certain extent only. Sanjay Joshi sir, kindly unmute yourself. Yes sir.
Hi AK, good evening. Very nice presentation.
Good evening sir.
One question I don't know if anyone has asked you earlier. With the new policy of government allowing us to invest in international markets, will you be advising we all investors in future to invest in US market and buying shares of 1/10 of a Netflix share? So a fractional share of all these companies, 1/100th of an Apple. Do you have any ideas?
Yeah, definitely. In times to come, we may include those, but not, at least not in the present scenario. We may consider, but let's let the NSE starts the trading. Also, BSE is going to start. Definitely, it gives a new perspective and new companies to invest. As I said in my previous query, I think from last more than 10 years, I used to think that if at all Gmail asked me to pay 100 rupees for 1 year, I would be very glad to use their services for rupees 100. I used to think at that time, and there are crores, means hundreds of crores of people who are using Gmail, how much money he can make. So that was the thinking, and I thought at that time, if Gmail would have been, Google would have been listed in India, I would have definitely purchased their share. So this holds good today also, but now most of the people know what the Google is. Similarly, new companies may emerge and you may get an opportunity to invest in even US based or presently only US based companies, and maybe in future some more countries may be added. But definitely it is a good sign for all of us to invest and in fractions, as you said, because we cannot invest so much of money for a single share. And we will definitely consider this option in times to come. Good question, sir. Okay.
Thank you. Thank you.
Thank you.
Thank you.
Mr. Sunil Bhambani.
Hello, sir. Good evening.
Good evening, sir.
Sir, my question is that market is all-time high, and I am your subscriber also. And previous to subscribing you, I am having some scripts also. And on apple-to-apple basis, I can say that I have earned quite a decent profits in them. Now, my concern is that should I exit from them and keep that after that, means amount should be kept in that and that demat only, so that if at all, God forbid, market goes down, I can re-enter. But similarly, I want to be cautious also. Ki suppose if I sell and again that same script raises, then that also is bit not acceptable to me. So what should a a layman investor like me do in this scenario, sir?
As I said in my previous in previous query, you should see. It depends. It is a policy matter. So you can have a different policy. I can have a different policy. But what I have found to be very useful and practical is you should always remain invested. And if at all you are worried that the market is very high, then shift to the safer stocks. That is the best way. Because okay, for example, on 23rd of March 2020, Sensex was 26,000, a little below 26,000. At that time, there were many investors who are holding cash and they thought that the market will come down further and then they will invest. And still they are holding cash. So that opportunity cost is too high. In a period of just 16 months, they have lost gains of at least 100%. And 100% returns in stock market on a CAGR basis, it takes 5 years. So they have lost 5 years actually. So there is opportunity cost is too steep. So I would not prefer to keep cash. Rather, I would. मैं तो अगर ऐसी जरूरत पड़ेगी तो मैं तो ITC में भी इन्वेस्ट कर दूंगा.
तो आप हेलो.
Yeah.
आप ऐसे बोलना चाहते हो कि you can at least churn your portfolio or you can reshuffle it, sir.
Yes, you reshuffle your portfolio towards more safer stocks. If you are worried about the market peak or if you think that there is a bubble, if you think, I don't think, but if you are very much worried, it is, see, risk appetite is different from investor to investor. For me, it is always the stocks which matter. But if you are concerned about the economy, if you are concerned about the stock valuations, then definitely I would suggest you to go for safer stocks.
Okay, sir. Okay. Yeah, thank you.
Mr. Umesh? Yes, sir.
Sir, good evening, sir.
Good evening.
And as usual, it's a delight and a pleasure to have your seminar. And I make it a point to always attend it. Even though I'm driving, I ensure that I attend your seminar, sir.
Yeah, I have heard that most of the time you are present.
Yes, sir. So my query is certain stocks that you have advised, sir, and that holding period would have got completed. But subsequently, after that, we'll try to sell that share. But then after that, we have seen sudden spurt in the price. Like, say, now, is it like the confusing situation is, should we hold it after the time period, or what is that? That's one of my queries, sir. And second thing is, as other investors were telling, it's not idle to keep cash. So invest all the cash and then keep churning it, right, sir?
Yes, that is what always for me. And now I can say with a lot of confidence, because even after 20 years, we have been able to generate 26.5% CAGR with so much of conditions. Means we have to make changes only on Wednesday, that to 11 a.m. And still, if we are able to generate 26.5% CAGR, that means whatever we are doing is working well. Of course, always we keep on trying to improve our returns, but this principle has done wonderfully well. Initially, we used to hold cash for about 4% or 5%, but of late, I mean to say, for last more than 10 years, I don't think we have ever kept a cash of more than 0.2%. We fully invested always.
Okay. So regarding the first question I had asked, certain shares, you give a time period.
It happens because the situation is very dynamic. Situation is changing very fast. Steel prices have started rising from last 9 months. Crude is now stable, and it was, people were expecting that it may touch to $80 per barrel, but it didn't happen. So lot many things are changing. Means they have become very dynamic. What was holding good till last quarter is not good today, and what was not good till last quarter is good today. So it is, and of course we all know it is because of the post-COVID, and also the lot of money being thrown into the economies, especially I would like to quote from the US economy. So it is very changing, fast changing situation. Yes, I do agree. We have exited from quite a good number of stocks, and share price have spurted after that. And in some of the cases, it is not that always the performance is good. In some of the cases, it is pure speculation. Not we never regret that why we exited so early. And if that be the case, that the stock is still good then we again reintroduce that stock. It has happened in number of stocks during the last 6 months.
Yeah.
So ultimately, what matters is how much returns you are able to generate.
So one more thing, you had told about that smart reports which you are going to come out shortly.
Yeah.
So this one, sir, on that?
Yeah, tomorrow, probably tomorrow or on Monday, we shall be launching that report and we shall share in our WhatsApp groups.
Sure, sir. Sure. Thank you, sir.
Okay, there is a question that please suggest period of annual returns that we should compare. Annual, I would like to have more this thing, annual returns of what? You mean to say the share prices or the financial results? So if you want to know how we should compare the annual returns, then if it is annual return, that means the returns for 1 year, then definitely you should compare with the last year returns. And if it is for the quarterly basis, then it should be on the similar period previous year. But as I said in my presentation, it has become very challenging to compare because during the last year, first quarter, there was almost for the 2/3 of the time there was total lockdown, and even for the current quarter, first quarter, there was a not that strict lockdown, but for a month there was strict conditions. So it is really very difficult to compare, and there is what I can say because there is no other solution. So what the best is, you should see the results on standalone basis. Don't compare. Okay. Okay. Now further clarification has come. How much last period we should consider for growth and profit? For at least 3 years. Yeah. If you are looking for a growth stock, then about 3 years. So, Mr. Ravi Kisan, you have more query?
Yes, sir. Can you hear me now?
Yeah. Tell me, sir.
Yeah, thank you very much, sir. It is a normal query, sir. I just want to know, can you suggest what should we read to get some ideas or to track, or at least what you do, like how you, generate new ideas, what you read, what you track. I'm not talking about the companies. Apart from that, to get a new idea, and for a retail investor like us or the newbies, what you will suggest to read?
Okay. Ultimately, what matters is you should be able to assess the business. You should be able to find the worth of the stock. If you are not able to do it, then follow some advisor. And to reach to that level, you need to read a lot of things, not only the daily newspapers. I also read the same newspapers as you do. I read Economic Times, I read Business Standard, and also the Business Line. So you get a lot of perspective, different perspectives, and after a certain period, you will realize that yes, that worked and this did not work. So that is how you create experience. That is how you learn, and there is the wisdom gained over so much of time. That is the one way. And also you must read the books written by those investors who have really created big wealth. I mean to say, the essays of Warren Buffett, or the annual report, or the quotes of Warren Buffett, books written by Peter Lynch. So these are the gems. They have created the wealth, not from those people who are theoretical in nature. So that is all. And also I have got an additional advantage because as I discussed during my presentation in Dr. Smart, I get lots of stocks to analyze. And when I analyzed, I definitely find 1 or 2 stocks from every investor's portfolio which are really worthy of investment, and somehow my team have overlooked them. So that is also one of the ways we come across. And also every quarter result, for every quarter, you should make it a habit that you should analyze the results for at least the top 500 companies. That is a very good way. And nowadays also the management gives the comment. that has a lot of meaning, and between the lines, what they want to say. In my last webinar, I shared one such quote given by, I think, Mahindra and Mahindra. So that is the way to increase your level, increase your perception about the market, about the stocks.
Thank you, sir.
Mr. Dinesh Tiwari?
Yes, sir. I have two more queries, some basic queries. Sir, one is just you quoted the name of ITC. Should the ITC be treated as a parking kind of stock, so that we can keep our money parked there, and then as and when we require, take some money from there, and then buy some good stock, growth stock. That is first.
I was just giving you an example, but ITC is not at all moving, and there is a lot of opportunity cost, a lot of opportunity investors have missed, because even I think in March it was 163 rupees, and today it is 205 rupees. So the
Yes.
gain 50%, while our SBP has increased by 200%. So definitely a lot of money has been lost. Opportunity has been lost by the investors, and when they will make the companies separate or demerge the companies is a very hard guess, because from so many years, rather I should say from last so many decades, they are all working in a combined fashion. But of late, the management is very much worried about the share price. You must have read the comments of the
That's why, sir. That's why.
Mr. Puri. Just 2 days back, there was a comment that they are very much worried about the low share price of their company. So they will definitely do something, but I don't expect anything kind of a miracle kind of thing. I don't expect.
And sir, second query is, sometimes you advise to sell a stock. For example, I will just randomly I will say a number. For example, you ask us to buy a stock at say 80 rupees, and then you ask us to sell at say 100, and or 80, or say some more higher price, say 150. Then suddenly we get advice of to sell that stock, but at another point of time, say after a few months, if we get the same stock at a further more than say 150, beyond 150 or 200. So in absolute terms, if we say apple to apple, then did we lose money in the first sell, or should we again enter into the same stock and then at a higher price, and then I mean, apparently it seems to be a loss.
Yeah, I will tell you what is the theory behind it. See, in smart gains, there are two parts. One is pick of the week, and one is the smart billionaire picks. Now, pick of the week is for investment horizon varies from 3 months to 24 months. And in smart billionaire picks, it is a perpetual. It is for very long term. So it is quite possible that I may ask you to exit from the pick of the week, but I may continue with smart billionaire picks, because the investment horizon is different. And also the story keeps on changing. There are many companies which we advised in pick of the week, whose story kept on improving quarter after quarter. Now the results come after 1 quarter, and the management comments are also made after 1 quarter. In between 1 quarter to second quarter, there is hardly any management disclosure. So we cannot wait for the next quarter, and we are targeting about 25% to 30% returns in a year. If we are able to get 20% returns in a month, then I would prefer to make an exit, because in the pick of the week, it is for medium term only. So if I'm making 20% returns in a month or less than a month, then it is far better instead of waiting for the next quarter. Anyway, that stock is, if it is that attractive stock, then definitely we will include it in smart billionaire picks, and you can follow that advice there. That way, you will not miss that opportunity. To give you another example, Bajaj Finance is in many of our schemes from last so many years. And also we advise Bajaj Finance in pick of the week. almost 1 or 2 times in a year. So from last 5 years, if Bajaj Finance is present in Smart Billionaire Picks, and if you are making 2 times advice in pick of the week, then both are gaining. So it is the investment horizon which matters. If you are a long-term investor, follow the Smart Billionaire Picks. If you are medium-term investor and if you think the market is heated up, then you can go for pick of the week.
Okay, sir. Thank you.
I am only giving an example. It may or may not be a part of the Smart Billionaire Picks. I hope I replied.
Yes, sir. Yes, sir. Thank you very much.
So with this, we have come to the end. And there is a last question from Mr. Ramesh Jagwani in the chat box. Long term, what is long term? Yeah, long term is 5 years, because any business cycle has a period of average, on average, it is 4 to 5 years. So one should remain invested in the stock market for at least one business cycle. So it is 5 years. With this, a lot of questions and a lot of interaction. I love replying to all your queries. Thanks for sparing your valuable time. And it is almost 90 minutes to this webinar. Thank you once again. Bye-bye.